Okay, so we're going to take a look at chapter 4. This is chapter 4 homework. So I say chapter 4 problems. There are also chapter 4 homework. And specific, there's a list of them that you can see on Sakai. And the first one I want to look at is exercise 4.9. And as you recall, this is the chapter on accrual accounting and more specifically adjusting journal entries. So let's look at exercise 4.9. The ledger of Howard Rental Agency on March 31st of the current year includes selected accounts below before, it says before, adjusting entries have been prepared. So you have a very limited trial balance there with some accounts. And it goes on to say, an analysis of the accounts shows the following. And we got 5 things we need to take a look at. And the instructions say, prepare the adjusting entries at March 31st, assuming that adjusting entries are made quarterly. Okay, quarterly. Additional accounts are depreciation expense, insurance expense, interest payable, and supplies expense, items that are not currently listed there. So the first item says, an analysis of the account shows the following. Number 1, the equipment depreciates $280 per month. Now remember, we're making journal entries quarterly. So we've got $280 per month times 3 months. That's going to be $840 of depreciation that needs to be recorded. And specifically, our journal entry, therefore, is going to be a debit to depreciation expense for $840 and a credit to accumulated depreciation. So remember, adjusting journal entries always affect at least one balance sheet account and one income statement account, never cash. Second item, it says half of the unearned rent revenue was earned during the quarter. So when we look at the trial balance, we have unearned rent revenue of $12,400, and they say half of it has been earned times 50%. So $6,200 of the unearned has been earned. So we need to reduce the unearned. The unearned is a liability, is an obligation to perform. So to decrease a liability, we're going to debit that. So it's a debit to unearned rent revenue, the $6,200, and a credit to rent revenue. It's a revenue account, and we increase a revenue account with a credit. Item number 3 says, interest of $400 is accrued on the notes payable, accrued interest. So they've incurred some interest expense that they have not paid for yet. So we're going to increase the expense and also increase a liability there. So we're going to debit interest expense for the amount of $400, and we're going to call it interest payable for $400. So we recognize the expense and we also recognize the liability. We haven't paid it yet. It's going to be paid. Let's continue on to item 4. And item 4 says supplies on hand total $850. So if we look at the trial balance, they have supplies currently at $3,000. And they said that there's 850 on hand, unused, if you will, unused, $850. So the question is, how much was used? How much of the supplies were used? Well, it's the 3,000 minus the 850. So they used 2,150. When it used, that means it's an expense. So we're going to have a debit. So this is item number 4, supplies expense for 2,150, and a credit to supplies. That supplies is the asset account for $2,150. So it shows the amount that was used. And then the last item here is item 5. And it says insurance expires at the rate of $400 per month. So we've got $400 per month. And again, this was for quarterly, so we've got 3 months. So they have used $1,200 of insurance. So we're going to debit insurance expense for the amount that was used at $1,200, and we're going to credit prepaid insurance for $1,200. Okay, so those are the 5 entries in exercise 4-9. Let's look at another problem, and this is going to be exercise going to be exercise 4.10. And let's read the problem. It says, Al Medina, DDS, a dentist, opened and incorporated dental practice on January 1, 2022. During the first month of operations, the following transactions occurred. And we see transaction 1, 2, 3, 4, and 5. And then they ask you specifically, prepare the adjusting entries on January 31st, at the end of what? At the end of the first month. So time frames are important here. We're looking at 1 month's activity. Prepare the adjusting entries on January 31st. Account titles are, and they give you some additional account titles to look at. First item says, performed services for patients who had dental plan insurance. At January 31st, $760 of such services were completed, but not yet billed to the insurance company. So this dentist has earned the revenue. They have performed the services. So even though they haven't collected the money, they have earned the income. So we have 2 accounts we need to affect here. And the first one is to increase an asset, accounts receivable, for the monies he's entitled to at some point in time. So we're going to increase an asset called accounts receivable, and we're also going to increase revenue. And again, that was for $760. So we're going to have a debit. So this is number 1. We're going to debit to accounts receivable. The $760, and a credit to some type of revenue account. Let's call it service revenue. Was $760. The second entry is utility expenses incurred but not paid prior to January 31st were $450. So they have incurred an expense but have not paid for it yet. So the second entry here is a debit to utilities expense in the amount of $450. That's a debit to increase that expense. And a credit to accounts payable, $450. Item number 3, purchase dental equipment on January 1 for $80,000, paying $20,000 in cash and signing a $60,000 3-year note payable. Interest is paid each December. The equipment depreciates $400 per month. Interest expense is $500 per month. So again, we're looking at 1 month's worth of activity. First entry we have is for depreciation expense. Remember, we're preparing the adjusting journal entries, depreciation expense, and it said depreciation is at a rate of $400 per month, and the credit is to accumulated depreciation, $400. And we also want to recognize the interest expense that has been incurred but unpaid. So in the same entry, we have a debit, interest expense, and they gave you the amount. You did not have to calculate it. It's $500. And a credit to interest payable, $500. Remember, they haven't paid it yet, but they will pay it. The interest payable indicates the obligation to pay. Let's go to the next entries. And this is going to be entry number 4. And it says, purchased a 1-year malpractice insurance policy on January 1 for $24,000. Now, they don't tell you at what rate it expires, but they did say what? They said purchased a 1-year malpractice policy on January 1 for $24,000. So it's $24,000 divided by 12 months. It expires at the rate of $2,000 per month. So at the end of the first month, at the end of January, we need to incur that expense. We're going to call that insurance expense for $2,000. And the credit is to prepaid insurance. We're asking for the adjusting journal entry. When they initially bought that policy on January 1, that transaction was a debit to prepaid insurance and a credit to cash. But we're not making that entry. We're making the adjusting journal entry at the end of the first month. So let's take a look at the last item in this exercise, and that is item number 5. It says purchased $1,750 of dental supplies, recorded as increased supplies on January 31st. Determined that $550 of supplies were still on hand. So they purchased on 1/1, $1,750. Sorry about that. $1,750 worth of supplies. At the end of the month, they still had, what does it say? It says specifically, on January 31st, determined that $550 of supplies were on hand. So this is called unused, and that was an amount of $550. So the question, what was used? How much did they use? They used $1,200. When you think used, you want to think expense. So we need to incur that expense. We're going to debit supplies expense for the amount that was used. And we're going to reduce the amount, we're going to reduce the asset by the same amount of money. And that asset is the supplies account for $1,200. Again, these are all adjusting journal entries. Let's look at another problem. This is going to be exercise 12. Exercise E4-12, chapter 4, exercise 12 from the Kimmel book. Let's read it. It says, the ledger of Armor Lake Lumber Supply on July 31st includes the selected accounts below before adjusting journal entries, and you see a series of accounts. An analysis of the accounts shows the following. And again, let's read the instructions. It says, prepare adjusting entries at July 31st, assuming that adjusting entries are made monthly. Use additional accounts as needed. So the first item they talk about here is the investment in the notes receivable earns interest at a rate of 6% per year. So this is a note receivable. This is an asset that they have on the books in the amount of $20,000. You can see it from the trial balance. And it earns a rate at 6% per year. And we're interested in recognizing the amount of interest income for 1 month. So we're going to have interest. So let's figure out the amount first, right? It was a $20,000 note. It earns a rate of 6%, 0.06 or 6%. And for 1/12, 1 month of the year, it's $100 of interest income. So we have an interest receivable $100 and a credit to interest income or interest revenue of $100 as well. The second item, again, this is exercise number 12. It says supplies on hand at the end of the month totaled $18,600. So they had a balance, they had supplies, they purchased originally from the trial balance $24,000 worth of supplies. And they specifically said, what? Supplies on hand at the end of the month of $18,600. So this is what? Supplies at the end of the month. This is unused. We want to know which was used. We want to know how much they used, how much they expensed. 24,000 minus 18,600 is $5,400. That's the expense. So we're going to debit supplies expense the $5,400, and we're going to credit supplies, the asset, the $5,400. That's items 1 and 2. Let's look at item 3. Item 3 says the balance in prepaid rent represents 4 months of rent costs. So we had prepaid rent of $3,600. $3,600, and they say that represents 4 months. So they're going to have what? It's $900 per month. The $3,600 represents 4 months, so it's $900 per month. And again, we're making adjusting journal entries for the 1 month ended July 31st. So we're going to have rent expense of $900, and we're going to credit the prepaid rent asset for $900. Item 4, employees were owed $3,100 related to unpaid salaries and wages. So we need to recognize the expense as well as the payable. Again, that was for $3,100. So we're going to have salaries expense, $3,100 expense, it's a debit, and a credit to the payable, salaries payable, for $3,100. Item number 5, depreciation on buildings is $6,000 per year. Per year, so $6,000 per year divided by 12 months is going to be $500 per month. So we're going to have a debit to depreciation expense of $500. And I abbreviated this A/D, accumulated depreciation, for $500 as well. Let's look at the Lex 2. This is still exercise 4-12. And we're looking at item 6. It says, during the month, the company satisfied obligations worth $7,400 related to the unearned service revenue. Satisfied obligations. That means that liability is going down. So it's unearned revenue. So if they satisfied, it means they performed services. So we need to reduce the obligation, unearned revenue, and we need to increase revenue, service revenue. So we're going to debit unearned revenue in the amount of $4,700, and we're going to increase service revenue, $4,700. Then the last item in this problem, item 7, says unpaid maintenance and repair costs. Assumes it was unpaid, they didn't pay it, but they incurred it. So we need to recognize the expense as well as the obligation to pay. So let's call it maintenance and repairs expense. Let's call it maintenance expense. And recognize accounts payable, A/P, accounts payable. And this is a debit for $2,300 and a credit for $2,300. That was exercise 4-12. Let's go back to exercise 4-11. So this is exercise 4.11, exercise 4-11. And it says here, the unadjusted trial balance for Sierra Corp shown in 4-5. Instead of the adjusting entries shown in the text, assume the following adjustment data. Well, you know what? We're going to skip this problem, okay, because this relies on the other one, and we did it very similarly. So we're going to skip 4-11. Did 4-12. Let's take a look at exercise 4.21. Exercise 4.21. It says selected year-end account balances from the adjusted trial balance as of December 31st, 2022 for Tippy Corporation is provided below. And you've got a trial balance. A, prepare closing entries, and B, determine the post-closing balance in retained earnings. In other words, the ending balance in retained earnings. So we're going to prepare the closing journal entries. So remember, there's 4 things you need to do. when closing the books. Number one, close revenue accounts to income summary. Number two, close expense accounts to income summary. Number three, close income summary to retained earnings. And number four, close dividends to retained earnings. Now remember, you're only closing the temporary accounts, and the temporary accounts are defined as revenue accounts, expense accounts, and the dividend accounts. All the other accounts are permanent accounts and they never close. So let's look at preparing closing entries. And first thing we want to do is close the revenue accounts to income summary. And revenue accounts have what? A normal credit balance. So you want to debit them to bring them to zero. The first one is a debit to service revenue in the amount of $183,800. And then there's rent revenue. And that's in the amount of $6,200. Debits have to equal our credits. I'm going to close it to income summary. Add the two numbers together, it comes up to $190,000. Second step, close the expense accounts to income summary. So expense accounts have a normal debit balance, so you're going to credit those accounts. So you're going to have a debit to income summary for an amount we're not sure yet, because we're going to add them up. But we know we're going to credit salaries expense in the amount of $91,100. We're going to credit depreciation expense in the amount of $13,200. I'm sorry, this is $91,100. We're going to credit rent expense in the amount of $3,600. And we're going to credit supplies expense in the amount of $1,400. So we add those four accounts up: salaries expense, depreciation expense, rent expense, and supplies expense, and that's going to add up to $1,093. That's going to be the debit. Remember, your debits have to equal your credits. So item one, we closed revenue accounts to income summary. Item two, we closed expense accounts to income summary. So now we're going to do what? Close income summary to retained earnings. But let's look at that income summary account. It's a T account, just like any other account. And you have debits and credits. So when we closed revenue, we had a debit of $183,800. And when we closed the expense, we had a credit of $1,093. So I have a balance left over. I have a net debit of $80,700. A net debit of $80,700. So we're going to debit. We're going to close this out, right? Going to bring it to zero. So we're going to debit. I'm sorry, this is backwards, isn't it? This is backwards. We have a debit of $1,093. We have a credit of $190,000. Sorry about that. So we have a net credit of $80,700. So we need to bring that balance to zero. So we're going to debit income summary of $80,700, and we're going to credit retained earnings for $80,700. That's our third entry, closing income summary to retained earnings. And then the fourth item we have here is we're going to close dividends to retained earnings, and dividends has a normal debit balance. To bring it to zero, we're going to credit it. So we're going to call it dividends in the amount of $26,300, closing it to retained earnings. It's a reduction of retained earnings, $26,300. So that's your fourth entry. And we want you to know what happened here, what went on with the account. So essentially, this is the statement of retained earnings, right? That's what they're asking you to do. And we're familiar with that. So let's call it retained earnings beginning. And we get that from the trial balance. And they specifically said the beginning balance was $61,800. And we just added the net income number, right? So we add net income, which was the balance in the income summary account of $80,700. And then we subtracted dividends in the amount of $26,300. So we have retained earnings ending in the amount of $116,200. Ending retained earnings. That's exercise number 21. So what I'd like to look at now is going to be problem 4-2A, problem 4.2A, and we're looking at only part A. And I'm only interested in the journal entries. So when it says specifically, prepare adjusting entries for the month of June. So adjusting entries for the month of June. So let's read it. Len Kumar started his own consulting firm, Kumar Consulting, on June 1, 2022. The trial balance at June 30th is as follows. And you got a bunch of accounts. Item A says supplies on hand at June 30th, total $720. So the trial balance shows supplies at $2,000, and they said that supplies on hand was $720 on hand. So again, that's the amount of unused supplies. So we want to know what was used, and it says $1,280 were used. That's the expense. Debit supplies expense, $1,280. Credit supplies, $1,280. These are seeming familiar, but practice makes perfect. Item 2, a utility bill for $180 has not been recorded and will not be paid until next month. So they're going to have a payable, so they have an expense. It's called a utilities expense. And they have an accounts payable in the amount of $180. Expense $180, accounts payable for $180. Item 3. The insurance policy is for a year. Well, they don't tell you how much it expired by, so we have to go back and look at it. And what we see on the trial balance is we've got $2,880, $2,000, $880 of insurance expense. And they said that is for a 1-year period. So we're interested in knowing what is it for the 1 month. So let's divide it by 12 months. The amount of expense per month, $240 per month. So we need to recognize the expense for 1 month. We're going to debit insurance expense for $240, and we're going to credit, we're going to reduce that prepaid insurance by $240 as well. Let's move on to the fourth item. Services were performed for $4,100 of unearned service revenue by the end of the month. So they're telling you $4,100 of the unearned has been earned. So we need to, number one, reduce the unearned by the amount that was earned. And we also need to recognize the service revenue. So we're going to debit. So this is item number 4. We're going to debit unearned service revenue. Reduce the unearned service revenue by $4,100, and we're going to credit service revenue. $4,100. Item number 5. Salaries of $1,250 are accrued at June 30th. So what does that mean? It means accrued. It means they have incurred $1,250 of salaries expense, but they haven't paid it yet. So we're going to have salaries expense of $1,250, and we're going to have salaries, what? Salaries payable. $1,250. Item number 6. It says the equipment has a 5-year life with no salvage value and is being depreciated at $250 per month for 60 months. So we're only interested in recording depreciation for the 1 month. So we're going to debit depreciation expense for $250 and credit my accumulated depreciation for $250. I abbreviate. And then item 7, it says invoices representing $3,900 of services performed by Kumar during the month have not been recorded. So they have earned revenue, but have not been paid for it yet. So they have to increase the receivables. They have the right to collect some money. That's going to be an asset called accounts receivable. And they said it was in the amount of $3,900. Going to increase that asset by $3,900. And we have revenue. So service revenue. $3,900. So you probably have a sense now that I'm really just concerned about the adjusting journal entries. You need to read what's going on. You're not recording transactions, you're recording adjustments. So that's the end of this homework. Thank you.